Hi, we're now on Module 2, Charting Basics. Were you able to do your own research? Okay then, let us compare notes. Welcome to the Responsible Trader's POV. These are my notes, my own additional research and studies on the topic that I posted, and my personal observations and opinions that I am sharing with you to further enhance our knowledge and understanding. Some of these were previously posted on the Responsible Trader thread of Stock Market Pilipinas. This is the latest version of previous posts I made. Some of these, plus further explanations and discussions, will be appearing in my forthcoming book, The Responsible Trader. Do you still remember Module 1? Let's do a quick review. If I show you this slide, what is the trend? Can you draw the trend line? If you answered that the trend is up, you're correct. And we draw the uptrend line by connecting L1 to L3. An uptrend has a pattern of successively rising peaks and troughs. Next one, what is the trend? Can you draw the trend line? If you answered that the trend is down, you're correct. And we draw the downtrend line by connecting H1 to H3. A downtrend has a pattern of successively declining peaks and troughs. Last one, what is the trend? Can you see an uptrend line or a downtrend line? If you answered that the trend is sideways or flat, you're correct. And we draw parallel lines H1 to H4 and L1 to L3. A sideways trend has no discernible uptrend line or downtrend line. Okay, let's now go to Module 2, Charting Basics. As you learned in Module 1, the technical analyst's weapon of choice is the chart. Charts are an invaluable tool for studying price movements. Charts study the recurring patterns that occur in stock prices because these tend to repeat time and time again. Prices tend to trend and continue until they encounter a change in direction. In this module, we'll study the three types of charts: line, bar, and candlesticks. I will just give an overview of candlesticks because this will be thoroughly discussed when we go to Module 8, Further Charting. A chart is a graphical representation of data in which the data is represented by symbols such as a line chart, a bar chart, or slices in a pie chart. A chart can represent tabular numeric data, functions, or some kinds of qualitative structure, and provides different information. If I give you the following intraday data for a certain stock, can you draw a line chart, a bar chart, and a candlestick chart? Let us plot this using a graph. On the left side, we have the price. Down below, on the horizontal line, we have time. We have 10 pesos at 9:30 in the morning when the market opened. We have 25 pesos at 11:30 in the morning when the stock reached its highest price for the day. We have 5 pesos at 2 p.m. when the stock reached its lowest price for the day. And we have 15 pesos at 3:30 p.m. when the market closed. By connecting the points, we have a line chart for the transactions of the day. The most basic of the charts is the line chart because it represents only the closing prices over a set period of time. The line is formed by connecting the closing prices over the time frame. If you have the line chart, assuming that you do not know what a price bar or a candlestick looks like, can you draw a single image for the day's transactions? This is what I call a transition image. If you extend the different price points, you are going to arrive at this image. So we have the high. The price bar is actually similar to the transition image, except that in order to simplify and denote the open, you draw it as a dash on the left side of the vertical line and the close as a dash on the right side of the vertical line. Incidentally, the vertical line is the trading range for the day, representing the difference between the high and low of the day. The bar chart expands on the line chart by adding several more key pieces of information to each data point. Generally, if the left dash is lower than the right dash, then the bar will be shaded black, representing an up period for the stock, which means it has gained value. A bar that is colored red signals that the stock has gone down in value over that period. When this is the case, the dash on the right is lower than the dash on the left. Let us now convert the price bar to a Japanese candlestick. But first, let us take a look back at history. More than 200 years ago, the Japanese were already using a unique style of technical analysis in the rice market that evolved into the candlestick technique currently used in Japan and elsewhere. It is not precisely clear who is responsible for inventing the candlestick chart, but nobody can argue that much of the development of the candlestick chart could be traced back to Munehisa Honma. Although he was the youngest son at the time, when tradition favored succession by the eldest son, he inherited his family's business on the merit of his extraordinary trading skill. Fast forward to our present time, a Westerner by the name of Steve Nyson discovered the secret technique called Japanese candlesticks, learning it from a fellow Japanese broker. The technique caught Steve like wildfire. Steve researched, studied, lived, breathed, ate candlesticks, and began to write about it. Slowly, this secret technique grew in popularity in the 90s. Steve Nyson has earned the moniker Mr. Candlestick and has written several books about the subject. The more notable ones are Japanese Candlestick Charting Techniques and the Candlestick Course. A Japanese candlestick is composed of two lines. A vertical line called the shadow or wick and the full height represents the trading range. Two horizontal lines representing open and close for the period, usually connected as rectangle. Let us now convert the price bar to a candlestick. Let's do it by extending the high of 25 to the right, the low of 5 to the right, the close of 15 to the right, and the open of 10 to the right. Doing that, we now have a green candlestick. It's called a hammer. Believe it or not, this is a candlestick with a name. Using our usual procedure, we can see that the open, the high, the low and close are all the same, 15 pesos. If you are in a relationship, this is what you call platonic. No action, nothing is happening. For this reason, in candlestick charting, this is called a four-price doji. When I started candlestick charting, I found it hard to remember all the Japanese terms. So I did some out-of-the-box thinking. I used keywords to be more specific Pinoy words to strengthen my memory association. For a better appreciation of candlesticks, let us do some out-of-the-box thinking and try to look at candles from the eyes of a Pinoy trader. A doji is a candlestick with no real body. Dojis signify indecision on the part of the buyers and the sellers. There are four of them. We have the cross doji, we had the dragonfly doji, we had the gravestone doji, and as what you've seen in the first slide, we have the four-price doji. My keyword for the doji is Dolphy, skinny when he was still alive. May he rest in peace. Sumulangit nawa ang kanyang kaluluwa. Japanese candlesticks with real body and without or very little wicks or shadows are called marubusu. We have the high, same as close, and the open, same as low. What you're seeing now is a green marubusu. It is bullish. What you're seeing now is a red marubusu. It is bearish. The closing price determines the color of the candle. If the close is higher than the open, then the color is green and vice versa. Marubusu in Japanese means close crop or shaven head and shaven bottom. My keyword is maraming nabusog. If you see something like that, shaven head and shaven bottom, I'm sure maraming nabusog na mata. Another keyword is maraming nabusog na traders because there are many trades that happened during the day. A candlestick pattern consisting of a candlestick with a real body followed by another candlestick with a smaller body is called harami. What you're seeing now is a bullish harami. This one is a bearish harami. Harami is a two-candlestick pattern where the last candle is contained within the range of the previous candle and is the opposite colored. Harami in Japanese means pregnant. So my keyword is harangi. If my wife is pregnant, I cannot make blank blank blank. Naharang ako. Just fill in the blanks. I might get censored by the MTRCB. Okay, I think you're getting the hang of it. We'll talk more on candlesticks on future lessons. For now, let us go to the next topic. The importance of viewing charts on different time frames. This is the PSEI, the Philippine Index. On the daily chart, it is showing a break in the uptrend line. On a weekly chart, it is showing that the uptrend line is still intact. On a monthly chart, it is showing a strong uptrend line. As a general rule, the longer the time frame, the more reliable the signals being given. As you drill down in time frames, the charts become more polluted with false moves and noise. Ideally, traders should use a longer time frame to define the primary trend of whatever they are trading. The interpretation of a stock chart can vary among different traders depending on the type of price scale used when viewing the data. The two most common types of price scales are arithmetic, also referred to as linear, and logarithmic, also referred to as log. An arithmetic price scale is plotted on the side of the chart so that there is an equal distance between the prices, and each unit change on the chart is represented with the same vertical distance on the scale, regardless of what price level the asset is at when a change occurs. By contrast, a logarithmic price scale is plotted so that prices in the scale are not positioned equidistantly. Instead, the scale is plotted in such a way that two equal percent changes are plotted as the same vertical distance on a scale. As you can see on the left, the price scale is the same distance between 5, 10, 15, 20, 25, etc. On the right side, if you notice, the price scale from 10 to 15 is wider than the one from 35 to 40. In general, most traders and charting programs use the logarithmic scale, but it is always a good idea to explore other approaches to determine which is the most suitable for your trading style. In summary, charts are one of the most fundamental aspects of technical analysis. It is important that you clearly understand what is being shown on a chart and the information that it provides. Line charts just show closing prices. Bar charts and candlestick charts show you the four prices: open, high, low, and close for each period. Candlestick charts are easier to interpret. Most charts allow you to see the volume of trading, which is important to indicate the strength of any move. You can use arithmetic or logarithmic price scales. Log is sometimes better on the long-term charts. Technical analysis can be applied to any time frame of charting. Okay, I think it's time to say goodbye. Before you go, please make sure that you subscribe to my channel so that you can get updated every time I upload a video. Don't worry, subscription is free and there is no obligation on your part. For those who will be buying my book, I will have another separate portion of the YouTube channel that will be exclusive only for them, and I'll be providing them with unique passwords so that they can access the relevant videos as they study the corresponding lessons in my book. Next week, we will have Module 3, Trend Concepts. Until then, take care, and I wish you all the best in your learning journey, and good luck on all your trades.